So I think in our planning we evaluated two things. One is the dealer group. Dealer groups themselves didn't make a lot of money, and a lot of the ones that had actually been created at the time were being done to achieve a capital sale. So if you build it big enough, someone will come along and give you an obscene checkbook and take you out. And we looked at that dynamic and just went, this isn't sustainable, because we did the mergers and acquisitions for a number of firms. So we went, that's not sustainable, but what is sustainable? And quickly you realise that corporates survive and do really well because they have a model that stands the test of time, invariably. And in that model, they participate in multiple parts of the value chain. So at any one point, they can loss lead in one and cream in another. And so we looked at that and we said, if we're going to go and make a fist of this one, we need to participate in multiple parts of the chain. We quickly realised Mark had done a lot of consulting in the platform space. So we looked at that and looked for gaps where the platforms in Australia weren't satisfying advisor needs, but importantly their client needs. We looked at what product gaps there were in the marketplace, and then we looked at dealer groups themselves and we said, what's missing? Institutions have got it right in that they were buying distribution at the time. Well, we went, we don't want to buy it, we want to create it. And we went that if you create the distribution, that can give you the support for some of these incubator type businesses that we wanted to create that would make a difference in our opinion. So we created Madison. And then in Madison, I think our first year, we bought an existing licensee. We changed the profile of that licensee irreconcilably. It was drastically different after 6 months than what it was we bought. And then we rebuilt it. And we rebuilt it by bringing staff into it, by bringing a vision into it, and importantly attracting advisors that we valued.